This is practice exercise 2, which starts with practicing classifying the accounting elements. It is a basic skill that you need to be able to do before you move on in the chapter. So cash, the item is money in the bank, or we call it in an account cash, is an asset. It's something that we own. Office supplies are also an asset. They're something that we own. Accounts payable, anything with the word payable on it is a liability, something that we owe. Office furniture is an asset, something we own. John Smith Capital, of course, is your owner's equity account. Drawing is also your owner's equity account. And accounts receivable is an asset. That's a promise from our customers that they will pay us. And it is, anything with the word receivable is opposite of payable. It is an asset. Once you finish that, you can check your work to be sure that they are all accurate. And then you can go on to number 2. Number 2 in the practice takes it a step further and wants to know the effects of transactions. So every time something occurs in our business, it's considered a transaction if it has anything to do economically. So John Sullivan has a business. During the first month in February of 2016, the following transactions occurred. Show the effect of each one on the accounting equation. Remember, our basic accounting equation is assets on the left equals liabilities plus your owner's equity. So he invested cash in the business of $27,840, which will add to your assets. You'll increase assets by that much, and your owner's equity will also increase. Remember, if you increase the left side of the equation, you also have to increase the right side for it to equal. So we have 27,840 and 27,840. If the amount box doesn't require an entry, you can leave it blank or you can enter 0, either one. Okay, the next one, we bought office equipment on account. So we didn't pay cash for it, but we charged it on account for $7,500. So we have more office equipment because we purchased office equipment and brought it home with us. That increases that asset. And we have more liability because we owe the money. So we add to our liability account. So I'm going to take out my calculator, and on the first one, my balance for assets would be 27,840 plus 7,500, and that equals 35,340. Okay, liabilities stayed at 7,500 because it was not affected by that transaction, or it was affected by that transaction, but that was the only effect so far. And then bring down your owner's equity of 27,840 because it was not affected. And as you go, you can also, just to check yourself, be sure that 35,340 equals 7,500 plus the 27,840. The left side should always equal the right side. Okay, on the next one, you bought office equipment for cash. Enter the change in cash on the first line and the change in equipment on the second line. Since two assets were affected, one of them was increased and the other was decreased. So we bought office equipment for cash, 8,700. So 8,700 decrease in cash, and an 8,700. Put a minus there, and 8,700 positive or plus. We don't have to put the plus. It assumes it's a plus for the cash. So what effect did that have on our assets? Actually, it just transferred it from one asset to another, so there's really no effect. 35,340. Nothing happened here, so it's still 7,500 balance. and nothing happened here, so it's still 27,840. Okay, and then the next one, paid cash on account to supplies, to a supplier in transaction, 2,410. So we're paying for that office equipment that we bought up here, so paid cash, so I'm going to hit minus 2410 to decrease that asset. And I also owe less money on my liability, so I'll decrease 2410 on the liability. Okay, so my balance here is 35,340 minus the 2410 equals 29. Let me try that again. 35,340 minus the 2,410 equals 32,930. And over here, I need to subtract 7,500 minus the 2410 for a new balance of $5,090. So $5,090 and 27,840 on this side. Check your work. And it's all correct. And then move on to the next one.